We're going to keep talking about this a bit, talk about the Fed's major consumer challenge. We're going to bring in Paul McCulley. He's PIMCO's former chief economist, and he now teaches at Georgetown's McDonough School of Business. Thanks so much for being here with us, Paul. I mean, you heard Steve, so let me just give you an open floor to get started. What do you think about what we heard today about the consumer, and if that changes anything that we're going to hear from the committee at the next meeting, maybe even what we might hear from Powell on Thursday when he speaks?
It's hard to disagree with what my friend Steve just said. The consumer is strong, period. We can have a discussion about why and wherefore. I think jobs and the fact that we have so many of households locked into wonderfully low interest rates are the 1-2 punch for the consumer. But from the standpoint of where the Fed is, I think President Harker from Philadelphia put it really nicely when he said that the Fed can do nothing, but doing nothing is doing something. And that's not just a riddle. I think it is reality, because we've had an inverted yield curve for the last year, which is the marketplace persistently saying, yeah, the Fed may have a little bit more to go, but then they're going to ease quickly on the other side. And I think what we're doing right now is reversing the easing on the other side. So the Fed being on hold resolutely, not hiking, not cutting, effectively is giving us a bear sloping of the yield curve, a bear disinversion.
Professor Paul, it's Tim Seymour. You were my first economist on Wall Street back in the day. I remember it fondly. You say in your notes that the economy is showing the contours of a soft landing, and yet, again, retail sales today don't show any landing at all. Can you explain the parts of the economy that you are concerned about, or at least do seem to be decelerating?
I think when you look at the retail sales in isolation, you could say no landing. But when you're looking at the overall mosaic of data, I think we are seeing a landing or a normalization, if you will, post the pandemic. And most importantly, we've seen the supply side of the economy respond, both from the standpoint of bottlenecks, but also the labor force participation rate. So we're seeing that normalization, which could also be called a soft landing. And also, I think it's important to note that we're seeing disinflation in wages, and that's a key part of the soft landing story. What we're not seeing is a sharp deceleration in job growth. So people may not be getting outside raises, but they're getting jobs and keeping jobs. And I think that is the sturdy portion of our economy, and there's every reason to expect it to continue sturdy. It will decelerate, but nothing precipitous. I think that's one of the things that we in the marketplace really have to get our arms around, is there's not going to be a precipitous slowdown. It's going to be incremental.
Paul, you said earlier that doing nothing is doing something. Steve Leisman talked about the possibility of the rate hikes increasing as we're looking at the January meeting. Do you believe that that will not happen at that point? Or are you talking about doing nothing now, later? What's your forecast for the possibility of hikes going down the road?
I don't think it's going to happen in January. I do think that the Fed is going to be on hold in a couple weeks' time. And when I refer to doing nothing, we have a 5 3/8 Fed funds rate. That's the policy rate. Just keeping it there will tend to pull up the entire yield curve. You saw that in the 2-year, obviously, day. It's, closing in on 5 1/4, but that's still below 5 3/8. So I think if the data flow suggests that the Fed, quote unquote, should tighten again in January, the marketplace will front run that in a nanosecond and do the Fed's tightening work for us, and would still give us an incredibly flat curve. I put a huge amount of emphasis on the inverted yield curve because it gives the Fed a lot of room to let the market do its work while it just sits there at 5 3/8.